You are likely working harder today than you were 5 years ago, putting in longer hours just to maintain your baseline. Yet, month after month, your bank account feels lighter. The groceries cost more, the rent goes up. You are running faster, but the machine is moving faster against you. This chart shows the mathematical reason why you feel squeezed. Look at the divergence between these two lines. The steep red line tracks daily expenses, inflation, housing, food, while the flat blue line represents the median salary. The cost of staying alive is accelerating, while the money paid to live is stagnant. The structural flaw in the blue line is how that money is generated. Traditional salaries are a direct trade of human time for dollars. Because you only have 24 hours in a day, your earning potential has a hard physical ceiling. Your expenses have no such ceiling. Corporate pricing and inflation are uncapped. When an economy pairs a capped income model with an uncapped expense model, the average worker faces a significant mathematical disadvantage. Earning a six-figure salary doesn't resolve this conflict. A doctor making $200,000 a year is operating under the same time constraint. If they stop seeing patients, the money stops flowing. The ceiling is higher, but it remains a ceiling. Maintaining financial security in the next decade requires moving beyond this framework. Since you cannot work more than 24 hours in a day, the focus must shift from increasing your hourly rate to changing how your income is generated. Relying strictly on physical labor creates a deficit that grows every year. This dynamic forces a transition into a different economic model, one where the math works in your favor rather than against you. The mechanism to detach your income from your time is asset ownership. An asset is a resource that generates money independently of your physical labor. Businesses, real estate, and stocks remove the human bottleneck from wealth creation. The distinction is simple. An income-producing asset puts money directly into your account, while a liability takes it out. A luxury car drains resources through depreciation and maintenance. A portfolio of index funds pays you to own it. Acquiring these assets activates compounding, the process where the money your assets produce is reinvested to produce even more money. The growth curve can accelerate autonomously, feeding on itself year after year. This chart shows the power of compounding over time. Look at these two investors. The first starts at age 22, putting away $500 a month. The second waits until age 40, investing $2,000 a month. The smaller, earlier investment eventually dwarfs the much larger, later contribution. At this interception point, the money generated by the system exceeds the money put in by the worker. The data suggests that duration in the market is more significant than labor intensity or the size of the initial capital. Wealth functions as a mechanical system of continuous ownership and time. It is the result of systematic accumulation rather than physical exertion. For decades, this system was restricted. Acquiring assets required massive upfront capital, access to institutional brokers, or deep professional connections. Current technological shifts are removing these traditional gatekeepers. The digital landscape has replaced physical access and institutional permission with open-source tools and platforms available to anyone. A smartphone now provides direct access to zero-fee platforms and fractional shares. You can buy a microscopic slice of a major tech company for the price of a coffee, removing the need for thousands of dollars in starting capital. At the same time, artificial intelligence and automation allow individuals to build and scale digital businesses without a payroll. Tasks that once required a full marketing department can now be handled by a single person using software. Despite this, many wait for a sense of market stability or a specific promotion before they start. They are waiting for a perfect moment that the data shows rarely arrives. With the removal of high-cost barriers and institutional gatekeeping, the primary variable in wealth building shifts from external access to internal execution. Tools like index funds and AI require a specific psychological framework to be effective. Building wealth by 2026 is as much about your internal metrics as it is your bank balance. This shift involves moving away from the question, how much money do I make? And focusing instead on, how many assets do I own? This perspective requires avoiding high-interest consumer debt, which acts as a form of reverse compounding against your net worth. It also means bypassing status symbols designed to impress others in favor of assets that actually build freedom. Emotional control is a requirement of this model. While others panic and sell during market drops, Those focused on accumulation see a discount. They acquire resources while the general public is exiting the market. The integration of artificial intelligence into the workforce is widening the gap between asset owners and wage earners. This divergence is accelerating, making the decision to own assets more critical than in previous decades. The infrastructure for the future economy is being built right now. You are deciding which side of the ownership line you will stand on as these systems mature. You will either use these digital tools to secure a portion of the future economy or spend your time paying for systems owned by